I think he's not contesting the third term. He lost a chance to have one of the best possible presidents in the institute. Let me tell you that. And as a matter of principle, he just left it because he thought that probably there could be other good avenues for him. And the moment he left it, uh, IFRS, that's the IFRIC Foundation, IFRIC committee picked him up of the IFRS, and he's in that interpretation committee of the IFRS at the international level. When we were discussing this topic, I thought that there could be very few as good speakers as MPV. He's one of the most respected persons in the profession, not only in India. Abroad, you can go to Dubai, you can go to Oman, you can go to Middle East, you can go to US and can find out for yourself what kind of respect he commands from the various members. He has been a brilliant teacher. That's the hallmark of him. Besides, of course, being the executive director of SIFI, he is also on the board of the biggest financial institution of the country, without which probably the capital markets even in India cannot run. That is the Life Insurance Corporation. He has been nominated by the government on that and is doing a wonderful job there. Vijay, we all know that these accounting rules which have mandated audit trail to be maintained effective 1/4/2023 accounting year, it is causing a lot of issues basically to the corporate world. And more importantly, it is causing a lot of issues for the members also. I do expect, because sitting on some of the boards, I do realize even the big four are finding it difficult to give clean reports somewhere. Because even in the SAP, certain privileged rights have been given to few people, very frankly, wherein they can log in and probably there could not be the sufficient edit log for that. That's one of the major issues. Of course, the other issues are which I did discuss with some of the MC officials also. One thing is very clear that there is no postponement of this particular provision. No way that it is going to be deferred because industry is facing some difficulties or the profession is facing some difficulties. It's not going to be deferred under any circumstances. But one surprising thing that I find, Vijay, is, and that I will like to have your comment on that. I'm told that internationally there is no requirement for the audit trail to be maintained. And that was precisely my question to the MCO officials. Because I asked them the issue that if I'm the holding company in India, there is a subsidiary company abroad where it is not mandated, or the holding company is outside and I'm the subsidiary, I'm mandated that, but holding company has not been mandated that. And if these two companies or two entities are using different softwares, how do we reconcile that kind of situation? The MC officials were not able to actually answer the question whether audit trail was mandatory outside India or it was not mandatory. And I'm given to understand, and quite reliably, that outside India, it is not mandated. And people say that if it is mandated by the regulator there, probably some of the companies will say, hell with it, hell with you. So if that kind of situation exists, then do you think that making it so tough for the Indian corporates or Indian auditors is too cumbersome? And I think it is overreach and it is contrary probably even to the ease of doing business. Of course, I do understand one thing that it has come primarily because of the fact that there were certain fraudulent transactions which were being recorded in the back date for which there was no audit trail at all. That's one thing. And there are other issues which will be there. And those issues which have been told to me, formally or informally, has been that it has been said that you have to preserve these edit logs for a period of 8 years. whether those edit logs are to be audited also for the auditor. Of course, that issue will not happen today because there was no requirement to maintain these edit logs in the last year. But going forward, probably next year, shall the auditor be required to verify these edit logs of the last year, that's of this particular year? And after 3 years, will he be doing the edit logs audit for the last 2 years? That is one part. And the other part is what is going to be the cost of maintaining all these records, basically. I'm told that it's quite a costly affair to maintain these records. Of course, the MC officials feel that it is not at all costly. I leave to them. The other issue is with regard to the consolidation. Because in consolidation, if you are using Excel or you are using spreadsheet, whether the qualification in the consolidated accounts will come from the auditors in all the cases, because for consolidation in any case, either the Excel will be used or the spreadsheets will be used somewhere or the other, probably for that matter. Or there could be some other issues which I will like you to address to yourself, or there could be certain issues which will be raised by the various members who have joined this particular talk. But I personally feel that this is one provision which is going to cause some kind of issue, at least in the first year. And it may take about 2 to 3 years to settle down this particular issue. It is not going to be very simple, as I have felt that even the issue with regard to changeover in the Ind AS from significant accounting policies to the material accounting policies. I find that in some of the big companies also, even the bigger firms are merely changing the wording from significant to the material accounting policies. So I personally feel that it is going to take about 2 to 3 years before it really settles down, whether it is audit trail or it is a changeover from the significant accounting policies to the material accounting policies. Again, I will repeat to the entire audience, entire members who are listening to this particular program or viewing this particular program, that we couldn't have found a person better who is hands-on, basically, in the CFI himself on this particular issue. And even theoretically, I think there are very few people who can match him in certain areas. So over to Vijay, straight away.
Sir, sincere thanks for all those very kind words and also introducing the topic so succinctly to ensure that there is attention of all the participants right through the entire session. The way you sensitized it, I don't think anybody will take their ears off, despite all of them also having a luxury of parallelly working while listening to the session. So thank you for that. And thanks a lot for the invite, sir. I feel very privileged to be part of this session and to interact with all of you here. Just one small caveat or small assumption I'm making. I'm making an assumption that almost all the participants here are auditors, practicing chartered accountants, and almost no preparers, But if there are preparers, then probably I'll modify a little bit. But if all of them are chartered accountants who are in practice, signing financial statements, issuing audit reports, I think this is a highly welcome move for the audit fraternity. It empowers them substantially. It is a very, very powerful tool, just like SA 701 on key audit matters. For auditors, the challenge always has been there are responsibilities in the audit standards, but the preparers do not feel so very responsible to ensure that auditors are able to discharge their responsibility. This particular requirement makes the audit much, much more effective and reduces the risk. And in terms of timeliness, what I would suggest is we are an economy which is growing at a very fast pace. And my experience of reading economies across the world in my career span, whenever there is growth happening at a fast pace, there are bound to be accidents, economic frauds. And in that kind of a situation, we have to be proactive to ensure that we minimize those economic frauds, minimize those accidents. And who better than the auditors can the government count upon for helping them in this journey of ensuring that the economic frauds are to the minimum? I've made a note of the few questions which you mentioned, sir, and I will address them along the way. I'll just open up my presentation. I'm not too sure if it's already visible.
Sir, it's not visible.
No, it is visible.
Now it is.
It's visible.
Okay.
It's very much visible now.
Yes, yeah. So what I'll do is, sir, I have a short presentation. I'll spend about 15 minutes or so just to give a good conceptual clarity. Then I'll come to a practical issues, and we can have an interaction with all the members. I'm sure the last few weeks, the work done by auditors, they would have come across many issues which they would like to discuss. I'm sure there are a lot of senior colleagues here who will also give guidance. And whatever thoughts I would like to share over the next 45 minutes or so, all of these are my professional thoughts. I'm part of a couple of other organization committees. These views are not belonging to any of those organizations. Now, let me begin with an introduction. As far as this audit trail requirement is concerned, what is new is only the fact that we need to report the audit trail existence and its effectiveness preservation. If you look at audit per se, we have requirements of SA 315, which I believe is the heart of audit. And we also have these requirements of internal financial controls, ITGC, information technology governance controls. All of these controls have always required that there should be a trail of what has happened. I think if we are going to say that before 2023, we would do audits without verifying the existence of audit trail, its effectiveness, I would call those audits as less qualitative. Absence of audit trail does not mean there is no reasonable assurance on financial statement, which is completely different. Audit trails are basically a mechanism to ensure that you can keep a track of a particular transaction right from its origin to where it is now. That's the purpose of an audit trail. Nobody is preventing anyone from going and editing a transaction. All that the requirement says is, if you're editing it, leave a record of the fact that you have edited it, so that somebody should know that when it was edited, what was edited. That information should be available. So as far as this audit trail requirement is concerned, I think as a learned community, as a very learned and intellectual community of accountants here, where all of us take pride that we all are part of the journey of improving governance standards, increasing the confidence of stakeholders in the economy. I think we need to look at how we can make this effective. And as far as the government is concerned, to be extremely fair to them, I think they have given enough time over the last few years. First, they have mandated the preparers to follow it. In fact, it's not just auditors. The map preparers are required to follow, and then the auditors are required to report on it. And it has already been deferred for almost 2 years. There was enough time available for people to get ready for this particular requirement, which became applicable from 1st April 2023. And as a profession, I don't think it is fair for us to approach now after the year end is over and ask the government to say that, why don't you reconsider the same? It wouldn't be very appropriate. Now, what is this audit trail requirement? It basically is nothing but a step-by-step record. A transaction got originated, and we are here doing the audit. 99% of the cases, what originated is what is there now. Some transactions alone, in between, would have gone through an edit. You would have done an edit. Most of us normally do an accounting edit by doing a journal entry, which is the right way to do. If you are doing it through a journal entry, then it's super clean. But if you have chosen to go and edit an entry which has already been passed, all that the audit trail requirement says is have a date and time stamp of the record of the transaction which you have been edited. And when it comes to audit trail, I think it's important to ensure that the stakeholders, particularly the board of directors, and I've come across in some of the boards, conversations saying that now that there is this edit log, can you give a mother promise that everything is correct? It's just not possible. All that audit trail does is it helps an early detection. So frauds are something which are done with lot of ingenuity. They are not meant to get discovered just like that. If it get discovered just like that, it won't be a fraud. So they take time to get detected. An audit trail actually helps for an earlier detection than what would have normally happened. So audit trail does not prevent a fraud. It just enables an early detection. From legislative perspective, this is a requirement which the government has brought in through its powers under the Companies Act, where the auditors are required to give a report on some additional matters. And among those additional matters, audit trail is one of those, and for which a particular rule has been inserted. Rule 11G has been introduced for auditors to report. And important to recognize that the preparer is primarily responsible for ensuring that this audit trail exists. In fact, sir, if you would recall, and I think the members here, many of you may not be aware, when CARO was revised and you had this long CARO coming in with multiple sub-clauses, effectively 60 items or so to be reported. Chopraji was the one who was actually guiding us through the whole process of getting that CARO done. And I so very clearly remember his conversations with the ministry that, look, before you make this CARO reporting applicable to the members to report, auditors report, ensure that the preparer is taking responsibility for the same. That's how the Schedule 3 got revised. The CARO implementation got deferred. It actually got deferred because Chopraji was pioneering the conversation that make the preparers responsible so that auditors reporting becomes easy. So if you look at Schedule 3 now, whether it is title deeds or revaluation, this, that, there's so many of those requirements the preparer has to first give so that it's easier for the auditors to report. Exactly the same formula, same approach has been adopted here. The preparers are being mandated to ensure that there is an audit trail. And auditors are required to just say, yes, it is there, it is not there, full stop. That's all the auditors are required to do. And audit trail, in simple terms, it basically is a visible trail of evidence which enables tracing back to the original input source. And I would like to reiterate at the cost of repetition, if you look at accounting transactions, 99% of transactions, the way they originate and the way they finally sit in the trial balance is exactly the same. It's only few transactions where you would have gone and edited in between. So if those have been edited, you require a chronological record of the changes which have been made to the data. Three things. When was it done? Who is the guy who has done it? And what exactly is the change which has been done? And I think as an audit fraternity, just look at how much comfort it gives to you as an audit fraternity to say that, yes, I know that this is how the transaction got originated. These are the edits done, and I have a record of what has actually happened. Now, the importance of an audit trail. It improves systematic approach for keeping records. Some of us can have arguments for ease of doing business. Smaller companies, companies with 3 crore turnover, 5 crore turnover, 10 crore turnover. These smaller companies always have a choice of different form of business structure, a partnership, LLP, etc. But these small businesses have chosen the cloak of a company. They wanted the cloak of a company because they wanted the benefits of limited liability. They wanted the benefits of the fact that you get the branding of being a joint stock company. And when the external stakeholders are dealing with that, a company gives them a little higher stature to other forms of business. So if you have chosen a company form of a business entity, while in reality, in practice, I have been a practicing chartered accountant myself for about 9 years or now. So, and I know most of the small companies, the accounting actually happens in August. It happens on September 24th. It happens on September 29th. At times, the financial statement is prepared and October 2nd, 3rd also you start doing back. So these are all hard realities. But as a developed nation, as a nation where we are having intellectual capacity rising, do we want to encourage and allow those to continue? Or do we want to do it? We should take the call of saying that enough is enough. Let's progress. If you want to be that way, do it as an LLP, do it as a partnership, do it as a proprietorship. Nobody is going to stop you. But once you come as a very high organized kind of a structure, it's important to be systematic. So the moment you come as a company, you need to be systematic. And the intent is to enable early detection of irregularities. And later, and we've all seen history is full of examples where whenever mischief happens, it all happens through these countless shell companies and these tiny companies. And it is those tiny companies where getting the records become very difficult. And this particular audit trail will actually help keep or minimize the risk of an economic fraud. Now, as far as audit responsibility is concerned, it's super simple responsibility. Super simple responsibility. There are four elements. Para number 1 has 2 elements. Para 2 has another 2 elements. And please note, this particular reporting is factual reporting. This has nothing to do with giving a reasonable assurance on financial statements. This has nothing to do with SA 705, modified report, qualified, etc., etc. Unless this particular audit trail aspect is so grossly inadequate that you are not satisfied about the controls, risk of material misstatement, and pervasiveness of those, when you would look at those things. But otherwise, this reporting is completely independent, and this does not, in 99.9 recurring cases, it will not have an impact whatsoever on your reporting to be done in SA 700, or if you're issuing a modified report, SA 705. So auditors reporting, para 1, 2 things. All that you're required to state is the accounting software used by the company having a edit log? Yes, no, that's all, full stop. Second is, was it enabled throughout the year, or it got disabled? Or it got enabled midway in the year, or it got enabled end of the year. There would be certain cases where, particularly first year, many people are operating in Tally. They would have got the relevant version of Tally, maybe from August 2023, maybe from October 23. Nothing wrong. Just make an observation that this particular feature existed from October 2023, full stop. Nobody's going to hang. You're just going to make a factual observation. And as Chopraji was mentioning, this will take its bit of time. It will take its couple of years' time. I'll give you a classic example. If you look at SA 701, the first couple of years when SA 701 came, most of them gave a long list of key audit matters. The list ran into some 10 items, 12 items, and all. It was templatized, copy paste. So company X did it, so I also copy paste and gave it. Management was also okay because what we were telling in key audit matters, we were saying that this was an important matter. We got satisfied like this, things are good. So management said, it's okay. You are only telling finally it's good. So you're actually increasing the level of confidence of the stakeholder. But that is not key audit matter. Key audit matters, key, really key ones. Typically, it's supposed to be 2, 3, 4 maximum, depending on the complexity of the transactions and other accounting aspects which are there. So that is para number 1. Para number 2, again, has 2 elements. What does it say? Very simple. Has it been tampered during the year? Now, as an auditor, don't I want that comfort? Doesn't it empower you? Doesn't it empower you to say that, yes, here is a law which says, gives me comfort saying that nobody has tampered it. So it gives me comfort. If somebody has tampered it, I'm going to make an observation that it got tampered during the year, full stop. And lastly, has it been preserved? It's part of books of account, and books of account are preserved for 8 years. So the edit log, if a voucher got generated and it got edited 2, 3 times in between, that log should also continue for the same period. It cannot remain for a shorter period than the initial transaction. So all it says is, are you preserving the same for the same period as what was there for the books of account? Now, this is important. From an auditor's perspective, and I'm assuming there aren't too many preparers who will come and kill me. As far as the management responsibility is concerned, this is the most important one. I think as auditors, I have been encouraging, and I've been probably telling at the pitch of my voice, that right in 2022, we should have highlighted to every board, every audit committee repeatedly saying that, look, this is the responsibility which you carry. It is the management who is responsible for ensuring there's an audit trail for every transaction which you're accounting, and your accounting software takes care of that. And the same has not been disabled. And if these are not there, then the key management personnel or anybody who identified by the board for this purpose, that person will be identified for non-compliance. The same is applicable for the directors as well in the director's responsibility statement. In director's responsibility statement, we have this motherhood kind of a responsibility, which is saying that we have taken adequate care, sufficient care, proper care for maintaining adequate accounting records, safeguarding assets of the company, preventing and detecting irregularities. How do you prevent and detect irregularities if there is no audit law? Directors are giving an assertion. They're giving a mother promise in the director's report that there are internal controls which are existing and they're operating effectively. And lastly, that within the company, there are adequate processes to ensure that you're complying with all the legal requirements. One of the legal requirements is the company should have an accounting software which has an audit trail which is enabled. So that's a director's responsibility statement. In fact, my view is this is audit trail reporting for auditors is such a powerful tool that you make the management, make the board of directors responsible for the same, so that tomorrow any governance gaps which are there, it becomes a shared responsibility and not the auditor's responsibility alone. Now, coming to the maintenance of books, we have completely electronic records, then the audit trail is applicable. If they are manual, then this entire provisions are not applicable. If they are partly electronic and partly manual, then again, this is applicable. Now, in the interest of time, this slide deck is available as part of the LinkedIn post. Interest of time, I'll skip this. But we have this set of rules which are mandatory on the management to ensure that these are all maintained. Now, coming to the IT environment, and this is an area of debate. And many of us have been actually been taken by surprise with the Institute's implementation guide in February. When it comes to the IT environment, where you're actually looking at the audit trail, we were all actually looking at the accounting software. But the core database of the company was something which we all initially assumed that for this reporting was outside the scope. But Institute has rightly, and I reiterate, it has rightly said that the database also forms part of the IT environment where audit trail is required. And if many of us today, particularly large companies, if some of us are struggling, it's on the database. And my recommendation to these large companies is that if there is a non-compliance on this where the edit log is not available, make a factual statement, but you can also add a paragraph. You can also add a paragraph saying that there are alternate controls and procedures which are available. For example, most companies, when it comes to database, rarely they go and touch a database. When they touch a database, normal SA 315, normal internal financial controls audit, normal ITGC audit will require that there should be a process of who will go and do the database edit, what will you do, and you'll have a log of the fact that somebody has actually accessed the database. So today, are there administrator logs available of who has accessed and when he has accessed? The answer is yes. What we don't have is a system-based log of what exactly the change was done. So that is a little difficult at a database level. It requires more resources which are there. It's increasing the cost a bit, but I think it's the cost of running the business. I don't think we have too much of a choice on that. So, but otherwise, the IT environment covers all of these things. It covers to applications which are hosted whether in India or outside India, premise, software as a service, or outsourced to a service organization. And please note, I know in India, there are many companies who outsource accounting to chartered accountant firms. So the whole accounting is outsourced to chartered accounting firms or some private companies belonging to those chartered accountant firms. So those cases, they're all service organizations for which we have a standard SA 402, which talks about how do you get satisfied that the control systems are effectively working in the service provider. And please note that SA 402 is to be applied independent of audit trail. Whether audit trail or not audit trail, I am required to do it. If I have not done it 2 years back, 3 years back, which means I have failed in SA 402. I have not done my audit properly. So that was a requirement which already existed, and that requirement now continues. And these are some questions which keep coming. Is it applicable for some of the other peripheral applications which eventually come and sit into the accounting aspects? Order to cash software, procure to pay software, payroll software, fixed asset register, financial closure softwares, compliance softwares. All of these softwares also, when they all become part of books and vouchers under the Companies Act. And all of them, if they're electronic and those information are flowing eventually into the accounting software, the audit trail requirement applies to all of this software also. Some of this software could be homegrown, some of this could be third party, some of it could be on-premise, some of it could be SaaS, some of this could be on public cloud, some of it could be private cloud. In India, outside India, doesn't matter. It's applicable to all of those things. Now, as far as auditors' work is concerned, we have this guidance already available in the audit standards, SA 230, which gives guidance regarding documentation. When you do audit of the audit trail, the SA 230 would apply. SA 315 for the internal control impacts. Then any deficiencies which are there, SA 265 will apply. If you're using a service organization 402, audit evidence requirements of 500. And at times you may rely on a management expert. Sometimes auditor appoints an expert, and I would encourage, particularly if the organizations are of reasonable size and internally capabilities are not there, please do not hesitate to engage an outside expert from the auditor side, even if it takes a bit of hit on the margin of the audit fee, engage an outside expert to come and do an audit of the audit trail one, because it is fairly technical. And organizations, if they're having 20 applications, some of them homegrown, some of them third party, some of them on cloud, some of them on premise, all of that stuff, APIs, all of those working and all. So it's important to get somebody who has a subject matter expert to do that, and SA 580 on management representation as well. So here I've covered how these respective audit standards apply. Interest of time, I'll skip a little bit. One good thing about SA 580, the institute guidance is they're given a illustrative format of management representation. Only one word of precaution I would like to mention. Management representation does not give you any protection. It does not give any protection unless you have been able to validate the contents of management representation, and there's an evidence of the fact that you have evaluated the contents of management representation and you have relied on the same. Only if that evidence is available, then the written representations are effective. Otherwise, those management representatives have no value at all. They're worthless piece of paper. SA 230 gives you guidance around audit documentation. For auditors, we have this 7-year requirement. Of course, for companies, it's a 8-year requirement. Concept of materiality, interesting one. Two aspects here. One is, as far as audit trail is concerned, it's a statement of fact. Even if it is not there for one, you have to disclose that it is not there. You don't have a materiality concept there. The materiality concept applies to the sample you select. So when you select the sample for which you want to test, for that you can apply the materiality principle. But once you have selected the sample, within that, even if there is one which is where you are not evidencing an audit trail, that has to be reported. So there is no materiality concept to be applied at that particular stage. So materiality applies only for the sampling part, but once the sampling is done, thereafter the materiality question does not arise. And as far as the auditors are concerned, the implementation guide gives you guidance on the wordings for an unmodified reporting and a modified reporting. My guess, large number of companies will have a modified reporting. And I would only encourage the Ministry of Corporate Affairs to give time to India Incorporated for 2-3 years for them to improve on this and not keep sending system-generated reports. That would be my only request to the Ministry of Corporate Affairs. I'm sure India Inc. will become responsible in the next couple of years. It is just that psychology, it's just psychology, the way all of us have grown up. Please don't mistake me for saying this. Typically, most of the work, we do it only on the last day. So even in my practice, audit practice, I would say, despite all the effort I do, the client work comes for filing and completion only on the last day. And even as children, most of us, the way we grew as children, we study only in the last minute. The same is true for audit trail. I think this is known for the last 3 years, but only now, after the audit process started for the earlier year, people are talking about how to handle all of these things, which is a conversation which should have had 3 years back. It's a conversation we had 3 years back. So I'm only hopeful that MCA will be fairly open to ensure that they don't send system-generated notices on this, just to be supportive of India Incorporated to improve over the next 2 years. My 2 cents, as I mentioned to you, and I would encourage that all of you, I don't know whether all of you are part of a single firm or multiple firms here. I think you should create a standard template and have it as part of your presentation to the audit committee or the board on the requirements of audit trail and what you have done for this, and make them do it. And many times at the audit committees and boards, I see the auditors feeling a little rushed. So they take an unwanted pressure and skip a few slides. I don't think this is a slide you should skip. It's just one slide. You should just drive it hard into those members of the board that, look, it is your responsibility. I have done my bit on where you are there, and this is where you are. So these are my 2 cents on this. So I'll just come to the few questions which have been raised by Chopraji. I think first question was, internationally, there's mono mandate. In fact, you're right, sir, there's no requirement. There's no requirement for very simple reason that it is assumed that it is there. So it is when you do an audit, you are assuming that the books of record have not been edited. If it is edited, there's evidence of the fact that it has been edited. That's an assumption. So in India, we have come to a stage where unless you are mandating, you would not do it. So we have come to that particular stage. Maybe other countries will follow suit, particularly the developing countries who have similar economic environments like India. They might follow India's model and say that let's also bring this requirement. So I expect to do that. There's nothing wrong that India takes a first step in few initiatives. It's not necessary that every time we have to follow. There can be cases where we can set the lead for the world as well. That's one point. Second is on the holding company and subsidiary. If the subsidiary is an Indian company and holding company is abroad, then the requirements of audit trail is only for subsidiary. Holding company, it's not required. But vice versa, if I am the holding company in India and subsidiary is abroad, I am controlling that. It's a subsidiary is a legal form of a branch in a separate entity. So you are controlling it. So you are required to ensure that that entity, because consolidated financial statements are prepared by me. So I have to ensure it is there. If it is not there, state a statement of fact that I have subsidiary in 3 jurisdictions. Those jurisdictions, the application does not have it. Make a statement of fact. There's nothing wrong about it. And there are alternate control procedures for us to satisfy ourselves that they're working effectively. Hell is not going to follow that. That's the second point. Yes, sir.
Here
Yes,
I
sir.
must stop you for a while.
Yes, sir.
Will it be possible that the holding company auditor, the parent company auditor, takes a certificate from the auditor of the subsidiary that he has checked the audit trail? Can he ask for it?
If the subsidiary is overseas subsidiary, sir,
Yeah,
100%, sir, 100%.
he can take, no?
Because, yes, sir, 100%,
Yeah.
100%. 100% you should do, sir. That's the second one. The third question which was there is on retention, whether auditors are required to verify for the part. I would say that even today, companies are required to retain the books of account for 8 years. And just look at our own audit process. Have I gone and verified? I have been in a practice, and I will admit openly, when I was doing audit, I never had a checklist to say whether the books of account 3 years back was there or not. It is my fault. My fault. To be very honest, I took it for granted. It never stuck me. But now that it is so clearly said in law, I think I should have a checklist to verify that yes, the previous books of account have been retained and all. That's a responsibility cast under law. And now that there's a specific reporting obligation here, so if 3 years down the line when verifying, I should go and check whether those earlier records have been preserved properly or not. I need to go and do the same. Then on consolidation, sir, consolidation, there are 2 ways we consolidate, sir. Some of us consolidate using spreadsheets. Then audit trail is not applicable for the spreadsheets. But if the consolidation is done using an application, a software, which will take the individual finance statement and prepare on its own, then for that application, then the audit trail would apply for the same, sir. Spreadsheet is more like a working paper, and for that, it is not required, nor there are retention requirements, except that as auditors, we have to maintain the working papers. And just one thing I was thinking in my mind when audit trail came, probably the government should have taken a phase-wise approach to say that larger companies, for example, India's companies, let them follow audit trail. And for the other companies, we'll give extra 2-3 years, let the experience settle down and then come. That was the only thing I had in my mind. It would have probably helped the smaller companies to scale up over a period of time. It's a little scaring for me that tier 2, tier 3 cities, how much knowledge has got disseminated, and the way the tally software people use, licensed, unlicensed, and all. I think that's a risk which is there. But I guess I think somewhere these hard calls have taken. When Caro came also, people made noise, but I think it's eventually settled and slowly the governance is improving. So that's all I have for the time being. I'm conscious of the time. I actually have a few FAQs which I have prepared, but interest of time, I'll stop here.
No,
And
I think you may go ahead with your
okay.
FAQ unless someone else has a question. But I would also like to welcome Charanjit Atra. He has already joined. So you take your FAQs before actually Charanjit, I hand it over to Charanjit Atra.
Okay. So Charanjit, good evening. And I saw also my good friend Sanjeev ji also. So good evening to both of you.
How are you?
I'm doing well, boss. Thank you. And I want to give you an advance notice that I've decided to stay back through your session and educate myself on ECL. So that's an advance notice from my side. Thank you.
Thank you so much, sir.
Okay.
You are trying to scare.
No, sir. अरे कितना बड़ा आदमी है सर वो चरणजीत कितना बड़ा आदमी है सर.
अरे नहीं सर.
Okay. I think someone has raised a hand. If the question's there, I'll take that first and then come here.
Yes, sir. We have one question. Shyam sir, can you please ask?
Yeah. Good afternoon. Thanks, Mr. Vijay Kumar, for the excellent presentation, and thanks for also covering up major parts of it, the audit trail part of it. I just want to get one point of view regarding the overseas components which are in the CFS, which possibly you have said that the audit trail will be required by the statutory auditors. I mean, I look at two things. One is books of accounts. The audit trail talks about books of accounts.
Correct.
So what is books of accounts, first of all? Is it CFS my books of accounts? As you rightly said, it is not. And then if you go, that is one point I'll be raising. The books of accounts is defined under Section 128 of the Companies Act. That essentially for the company, number one. Number two, the implementation guide and reporting on audit trail, paragraph 17, I'll be referring to your kind attention, please, which says the auditor is required to comment on the above matter, both in case of reporting standalone financial statements and CFS. However, while reporting on CFS, the auditor may observe that certain components are in the consolidated financial statements are not companies under the Companies Act, might be trust, or such components are not incorporated in India. In that case, the auditors are not supposed to report. That is again first part of it. I wanted to bring it.
Yeah.
And the second part, I mean, if we had a detailed deliberation on the entire aspect also earlier, I'm saying that on the CFS part, again, the institute has given 25D, which says the FAQ on 25D of the guide, the implementation guide says, unless again, it talks about books of accounts, and it says if I'm using an Excel sheet in which I'm compiling my revenue, and that revenue is not out of it to the books of accounts, my ERP package I'm using for books of accounts, then that is not part of my books of accounts for audit trail. And that's possibly the major intention of the act overall is not to apply to those entities which are not within the Companies Act, number one, not to apply those, I mean, again, when I'm talking about Companies Act, suppose, as you rightly said, a company which is an overseas foreign company defined under the act, meaning thereby an overseas entity having a business in India. Obviously, in that case, it will be applicable. So I will be requesting to have your opinion on that, please. Thank you.
Sir, I think you gave the final position actually. You actually read out what's there in the institute guidance note, implementation guide rather. 2 points just to reiterate. One is the spreadsheets which are used for any purpose whatsoever, including for consolidation or they do not constitute part of the accounting software and consequently don't require an audit trail except where a spreadsheet has been developed in such a manner for capturing the data which gets pushed into the accounting software. For example, if an organization at a branch maintains its sales records on spreadsheet, and that spreadsheet is directly imported into the accounting software end of the day or whatever. So if that kind of a model is applied, then the spreadsheet would also qualify as an accounting software. So that part, I think institute guidance is also pretty clear. Now, as far as the overseas subsidiaries and entities which are not companies are concerned, I think what the institute guidance says, and it rightly says, is that if it's applicable for both standalone and consolidated. And consolidated, we are aware that there are many business houses in India where the parent entity is just a holdco. It's just a holdco. And all the operating entities are subsidiaries, associates, and joint ventures below. So those subsidiaries, associate joint ventures can be Indian, they can be overseas, they can be any other form of business organization, LLP, trust, or whatever form it can be. Now, in the holdco, when you consolidate, you are actually communicating the results of all of the entities which are effectively controlled. First choice is to have an audit trail of all those controlled entities which are there. Second, if those controlled entities are overseas entities, where the law Companies Act is individually not applicable to them, or the controlled entities are a trust or a LLP, for which again this requirement is not there. Those cases, the implementation guide says, make a disclosure of the fact that the consolidated financial statements includes 2 overseas subsidiaries for which there wasn't an audit trail requirement, and consequently same is not there. But as an auditor, you have to still evaluate your SA 315 risk. Similarly, there are 3 LLPs which are special purpose vehicles where we are carrying so-and-so activities, for which again audit trail requirements are not there, and consequently the same has not been reported upon. So that factual reporting you need to do. That's what the implementation guidance states. I hope I've clarified.
Oh, that's exactly I was looking at, because initially possibly the thought was coming, no, it will be required to be mandatorily reported.
No, sir.
Because the essence of this particular act is not to cover those companies which are outside.
No, sir. I'll just make a small edit to what I said for clarity. Now you are reporting the fact that मेरा 2 subsidiary है बाहर, उधर audit trail नहीं है. Now imagine you are a listed company with reasonably good public interest. Now that statement of fact you are allowed to make. You are allowed to make that. But as an auditor or even as a preparer and as a board, would you be comfortable to say that there are 2 entities which there are no audit trail? So what I said earlier is, if I have controlled entities anywhere and in any form, I would like to have the same level of governance which is there, while the individual law is not applicable. And the implementation guidance just says that if it is not there, any case law is not applicable. So sirf bata dena ki nahi, udhar nahi hai, bas. But as an auditor, my risk is there and it is pretty high.
We have a question from Nishit sir.
Yeah, Nishit, go ahead.
Very good evening, CA Vijay, for a wonderful thing. Sir, I just have 2 small questions. Number 1, what would be your recommendatory best practice for a CA firm to obtain the data to be audited, whether it's an audit trail data? So when a CA firm, people go there, the partners or the executives, and they have to obtain the data from the client, even to verify the audit trails. So what is the best practice or approach you would suggest they should be adopting?
You said 2 questions, Nishitji. Can I respond?
This is the first one. Yeah.
Okay.
The second question is,
yeah.
The second question is, in case a fraud has happened, it has been highlighted by the auditor, the company decided to go for the legal action against the fraudsters, and the matter reaches the court of law. The base evidence for the case under fraud is the audit trail from where the trigger was taken by the auditor. Yes, the fraud happened. As the audit trail contains what was the original data, who modified, which day modified, whatever happened, backdated or current dated. So all that is being formed as an evidence in the court of law, based on which the case is. Now, to make this evidence legally sustainable in the court of law, what are the best practice or precautions or recommendations you would suggest?
I think both questions are quite interrelated, Nishitji. I'm not too sure about the best practices, because at this point I don't have exposure to the practices of many organizations. I don't have that. Today, what all of us have done is, for all the applications which companies are using, the core accounting and all the supporting applications and database, what all of us have ensured is that there is a edit log feature available in that particular software, And that edit logs feature is being reviewed internally by whoever is the identified management resource. And then we have put in place a practice of internal auditors also going through, because it's initial year, we told them to do a quarterly reporting of how those edit logs are all effective. And the statutory auditor relies upon these things. So that's how we have gone about it. So we've gone about it.
Sir, like you said, like there could be internal auditors or there would be other consultants or people doing this and giving the report to the year-end statutory auditor or half-yearly. Now, even those internal auditors, when they are at a client site, is there any recommended procedure to be adopted before they take the data for doing this kind of job? Or what should be done? Or they just go and give the data?
Yeah, I think sir, as an auditor, we have access to the entire application. So we take that access and we go and see what is the edit log available, and edit log when it has been used, who has used it and what purpose is used it. So we just go and verify the same. And why I said internal auditors on a periodic basis, because you are supposed to ensure that this edit log existed throughout the year and it has not been tampered throughout the year. So if you do a year-end one, you could miss out on some of these aspects. That's why it's a test which ideally has to be done throughout the year. But otherwise, we do have an access to the application. It is we who have to go and verify it and get satisfied about the same. The management doing it, internal auditors doing it are all support practices which help you to come to a more confident conclusion that the audit trail was effective right throughout the year. It's not been tampered, etc., etc.
Sanjeev.
Yeah, sorry. Thank you very much. I think MPV, one point to your point that all of us are auditors, but I am not. Just to kind of just two very quick ones. I think paucity of time. You see, when you look at the independence standards, or when you look at anything, when it comes to audit, should there be a difference between a small or a big audit? Because it is a question of an audit trail, or as you mentioned a couple of times, that it'll help you probably much more a confidence in the audit being carried out, and for the management also it is a good tool to have. So that was point number one. And second, related is it the industry which is asking for a deferment, or is it us as members of the institute? Because then both of them are at fault to say that this should be deferred, because it helps a better control on the financials both ways, as you mentioned in your presentation. So those are the points.
Sure. Sanjeev ji, as far as small and large is concerned, my view is the following. Why I said small and large was because the ground reality and sheer economic aspects of the whole process, I thought a phase-wise approach would have probably been a better one. And on independence, what I want to say, Sanjeev ji, it's something which I don't think any of the participants here will like me to say this, but I'll just say this so that it becomes something for ideation. Ideation is that for smaller entities, we should actively debate whether we want to do an audit. We should probably move away to accountant report instead of an audit. If you want audit or an assurance, then there is nothing like small and big. But if it's an accountant report, then probably you can have a different set of framework. So users will also read it a little differently. So maybe we have to debate, all of us, as to whether it is time for India, like in the developed countries, that we give up audit for smaller ones and move to an accountant report. But otherwise, once audit is there, then it has to be uniform. I don't think we can have different standards there.
I will only say, Vijay, that probably what you said with regard to the small companies audit, we may hear after another couple of years, if not immediately, because I think we ourselves will be to be blamed for all this. I don't want to elaborate more on this, very frankly, because all the frauds that taken place through the private limited companies, if you really ask me, these have been used as the shell companies, and we failed to bring it out. And that is why the government says, why the audit of the private limited companies? So
I agree.
I think we all have to be.
No,
very
I agree,
clear
sir.
about it.
I agree on that, sir. I agree on that. I agree on that. I agree on that.
Rikin,
No, I fully
think
agree, sir.
last question by Rikin, because Charanjit is already there, so I don't want to waste Rikin.
Okay, am I audible?
Yeah, Rikin.
Yeah. So only question that I have is that, see, basically if you are in a ERP environment, then there would be certain rights which is allocated to a super user. Like there would be some risk team or something kind of that who would be having a super user rights, right? So they may be able to, let's say, modify the background tables of any ERP processes or whatever on a need basis. If there is, let's say, extraordinary event in such scenario, they would be having such right. So would that be considered that I'm not having a efficient audit trail, or how that reporting would go?
Yes, Rikin. Actually, that's the point of debate which has come up after this February implementation guide. But you know that, let's take the case of some of the big scams which I had, including, I don't want to name, but being a closed group, I'll name it, like Satyam. It was a database level edit. So it's important that those also have to be covered by an edit law. So the institute guidance implementation guide says that it's applicable for database as well. And I think that's the hard reality. And people are touching database, whether we like it or not. And Chopraji, from his vast experience, has said that there are all these smaller companies where so much mischief happens. And those companies, if databases are all tampered, I think the country requires better governance. And I think we should work in that direction.
The only thing, Vijay, that one will like to say is that if there are certain tables which are touched upon, which do not have any financial impact under any circumstances, but only the tables which can impact the financial results. If you touch those, probably the question of edit log will be more important there, because I can tell you in the hotel industry also and the other cases also, this issue is being raised, that there may be thousands of tables basically in any in industry. Now, if you are touching upon something which has no impact upon the financial results,
we have to look at it a little differently there, sir. Like, for example, we look at quantitative data, whether it is of inventory or quantitative data. Hotels also, you have quantitative data. But those quantitative data form the basis for the financial data and for cross check and all.
Agreed. So wherever it forms the basis for quantitative data or financial data, that's fine.
Like attendance records. Attendance record becomes a basis for payroll. So those cases. But if it is completely independent, like for example, marketing data. Let's say I capture data of how many campaigns I've run, what is the response to the campaigns, etc. Then it doesn't have a connect.
That's the point that I'm trying to make. That's perfect. The only point that I'm trying to make.
Those are excluded, sir.
So thank you, Vijay. Thanks a lot.
Thank you, sir. Thanks a lot.
Brilliant and very, very super presentation. In the sense that it was easily understood by one and all, for that matter.
Thank you, sir. And I see a lot of senior members here, sir. I seek their blessings. I seek all of their good wishes and blessings as well. Thank you.
So thank you very much. And Charanjit.
Thank
you. Charanjit, welcome to you.
Good evening, sir. Good evening, everyone.
The person who has donned many hats, very frankly, if you really ask me. He has been partner with Asar Barley Boy and has been an expert in the financial instruments. He has been representing wherever he was on the accounting standard boards. He was a special invited to the NFRA also, NACAS also for that matter. And more importantly, in various committees of the SBIs where the financial instruments were discussed, he was always a part thereof. And more importantly, he had the privilege to be the CFO of the largest bank in this country, public sector bank in this country, not the public sector, rather any bank in this country, without which the economy cannot run. And I personally feel that that is one bank, State Bank of India. If at all the growth story of India will be written, LIC and SBI both will be very important parts of that. And today he has joined so the I think the most upcoming, I will not say upcoming, the most important group, the Geo Financials basically, and is leading the team there as CEO. So I don't think you need more introduction than this, Charanjit. And having interacted with you on many forums, not one, uh, I can say that we couldn't have had a better person to talk on this expected credit loss model, particularly from the practical perspective. Everyone will know that there are going to be three buckets in any case, and but how to actually go along with these three buckets and how to create the provision. Now, what the companies are doing, everyone says that I'm following ECL model, but if you are only having the debtors in your books of account, then it is nothing but a simplified approach. You may say that you have the ECL model. So probably what is more important is if you could give us a practical shape of how to calculate the provision with regard to the ECL and how it will affect the various financial institutions, the NBFCs in particular. That is what we shall be looking forward in the next 45 minutes or so.
Sure, sir. Thank you so much, and thank you so much for the nice introduction and the guidance that you have given me over the years. I was just thinking, the first time we would have met would be sometime in 2008, and since then, I've had the opportunity of working with you under your guidance. I'll just share my screen so that we can.
Yeah, please.
Is my screen visible?
Yeah.
So before we actually get into discussing, and as Sir rightly said, that everybody has read the standard, everybody knows about what ECL is all about, everybody knows what are the technical requirements. But the question clearly is there are a lot of myths which go about ECL. And it is very important that if you need to understand provisioning under ECL is to sort of remove all those myths, maybe de-learn what we have learned, and then go on to understand what ECL is all about. Let me start with saying it's quite simple, it's quite straightforward. It's only how we apply ourselves to get to that number which goes as provisions into your P&L. Now let me start with the journey from what we are doing now and how we are going to move forward to ECL. I know there are many people on this call, and everybody would be at different levels of experience with ECL. But for the benefit of all, I'll sort of start with a little bit of basics, and then we might go to more details in there. Now, as we are speaking, as we talk about Reserve Bank of India's IRAC norms, we have two levels where we create provision. One is provision on standard assets and the provision for non-performing assets, where default or a non-performing asset is defined as an asset which is overdue for more than 90 days. We create percentage-based provisions. We say on a standard asset, it's about 0.4 to 1%, depending upon the category. And on the NPA, it is anywhere from 20%, 30%, 50%, 100%, even depending again upon the stage of that loan is. Now, many people you would have heard, you would have discussed jokingly saying that, ECL seems to be like guessing numbers in a crystal ball or, doing astrology or whatever. Now look at what we are doing. We are applying a 0.4% provisioning here. I'm not sure whether anybody knows what is gone behind that 0.4%. Similarly, we do based on time period 20, 30, 50%. Once an asset goes into an NPA, again, we don't know whether the 20, 30, 50% is right or wrong. Then suddenly what happens on the 89th day, a loan has a 0.54% provision. On the 91st day, the provision increases. As an accountant and a financial professional, that always bugged me, saying that, what happens in the 2 days when the provision suddenly increases? Shouldn't we have benchmarks in between so that provision increases drastically? And then how would I distinguish between a loan where I have full security, say for example a gold loan, where I have the value of gold, where I'm sure I'm not going to make losses at all, and on a personal loan where the provisioning percentages are the same? Once I look at that, I said, what does ECL do? ECL first has made provisioning in a gradual form, starting from 0 to 30, 30 to 60, 60 to 90, and beyond that. On the second part, it has left the calculation of that number, one which you apply on your outstanding or on your exposure, to the entity itself. And I'll come to that, how that is computed, because that is something which is critical to this entire discussion that we are talking about. So that are the two changes which is being made by ECL, and we'll discuss what happens. First of all, let me also bring one clarity. What ECL does, it applies to all assets which you're not marking into fair value, all financial assets, which includes assets which are at amortized cost, which includes assets which are at fair value to profit and loss account. Further, ECL is applicable to the entire exposure, which could mean include loan commitments as well as financial guarantees which are not measured at fair value. In trade, and I'll come to trade receivable and contract assets later, because there we apply the simplified method. So now, before we get into a discussion on the simplified method, the coming slides, about 14 to 15 slides that we have, we'll be talking about the general approach. And then, in the last two slides, we talk about the simplified approach, which is more of a loss rate approach, where we directly compute the loss rates. Let us look at what the standard says. The standard for measurement of expected credit loss talks about an probability weighted approach. It talks about where you evaluate a probability weighted cash flows by evaluating a range of outcomes. It talks about time value of money. It talks about reasonable and supportable information without undue cost and effort. So let me start with this thing. Many people feel, and when we talk about that, how are we in a position to look at a borrower's cash flow projection, or what is happening to the borrower going forward? My answer to this is, as bankers, we lend money to these borrowers by looking at their future cash flow, by looking at their repayment capacity. Now, once we have done that, that becomes a base rule. The question is, as the loan progresses, as the tenure progresses, we need to evaluate where are we as compared to what we projected in the first page. And that is where it comes to whether from what we had estimated at year time 0 or before granting of the loan, whether the cash flows that we are expecting or the business prospects we are expecting on the date of evaluation is same, or it's gone down or gone up. If it's gone down, then you test whether it is significantly gone down to have an impairment. And then you actually calculate the PDs and LGDs to figure out. I'll come to the PDs and LGDs there, but the clear thing is, we need to examine at every point in time what was the difference between the cash flows that were there at the beginning and the cash flows which there at the time of evaluation. The standard requires us to do it once a year, revisit these assumptions. You can do it more, but I think this definition in some depth, it talks about cash flows, it talks about present value of the cash flows, it talks about probability weighted outcomes, which means what could be the outcomes normally, if I see practically what is being practiced and what is being implemented is, in case of large corporate loans, it is done, you take a positive outcome, you take a negative outcome, and you take a realistic outcome. So minimum 3 outcomes are predicted, and they're stressed in, first from a realistic, from a positive outcome, it is stressed down, and it's stressed down to see, what are the 3 outcomes. Probabilities are assigned to those outcomes based on the general market conditions. You find the probability weighted cash flows, you present value it, and the difference between the outstanding and that number is the provision that you need to create. That's what the standard says. And, it looks complicated, but when you actually start putting those numbers, it's basically trying to say that you estimate the loss which is there in the portfolio as of today, or in that loan which is as of today, based on what is the expected cash flows. Now, the question is, are we supposed to compute those cash flows? Are we supposed to know that cash flows? The answer is no. The cash flows will generally be provided by the borrower. The only thing that we need to see there is any indications, any things which, sort of are evidencing that be true, and maybe look at cash flows that just. Otherwise, I think for larger loans, doing provisioning is one of the best things to do. Now, again, the do it for all loans. Do it a bank or an NBFC or any other financial institution would have huge number of loans and huge number of outstandings. So do you think that, should we do it for all? The answer is clearly no, because the standard also allows you to group certain loans based on similar set of risk or similar set of criteria, which I'll discuss in the standard, and where you can use similar downgrades or credit risk or probability of default in those areas. So ECL, again, coming back to from where we started, and sorry sir, but I need to go into this slide of saying the 3 buckets, because this is where we end up into. What does the standard say? The standard say, if I compare this with an RBI lens, stage 1 and stage 2 are our standard assets, and stage 3 is where our NPAs would lie. So what ECL has done is broken up into the standard asset into 2 parts, which is stage 1 and stage 2. In stage 1, it requires you to provide only for the 12-month expected credit loss. It still allows you to accrue interest. In stage 2, it requires you to calculate a lifetime expected credit loss, still allowing you to accrue interest. In stage 3, it's like an NPA. The probability it's default or very close to default, and you provide again lifetime expected credit loss. Plus, it is treated as credit impaired, and interest accrual is allowed on it on the net amount. Net amount would mean your gross amount minus the provision. Now, the next question here would be, how do the loans move from stage 1 to stage 2? Generally, as I've said earlier, you have had a risk profile of the customer on day 1 before you granted. You had the cash flows, you had everything before you granted. How has the performance of the borrower moved from that date to the date in your valuation, on your valuing date? If there is a significant deterioration in the credit risk, then only in that case, you move from stage 1 to stage 2. Mind it, by this time, we assume there has been no default. It is just a qualitative aspect. However, there is a backstop arrangement also, the backstop this thing given by the standard, where generally if an asset is more than 30 days overdue, it moves on to stage 2 automatically. This can be rebutted. This is a rebuttable presumption. If you have evidence to show that even if an asset is more than 30 days overdue, it's really not significantly credit deteriorated. Similarly, if your asset is outstanding or a loan is overdue for more than 90 days, it moves into stage 3. The standard has defined 90 days as default rate. So mostly in your stage 3 assets, this will be the default loans. There is nothing stopping you, nothing holding you back to classify loans from stage 1 to stage 3. So it's very important that you classify this asset into stage 3. Again, comparing it to what we have been doing now, with RBI, what RBI IRAC norms are spoken about, very similar. Only thing, standard assets broken up into two stages based on deterioration in credit risk. And obviously on stage 3, you don't assess any credit risk impairment. You just assume what is going to be your loss given default, or loss given default is nothing but 1 minus credit risk. Once you do that, that's what your provision is. So overall, ECL talks about estimating your losses today. Let me also tell you, in ECL, you will be making provision on day one the asset is disbursed, because all assets will have a credit risk. So your stage one, the 12-month expected credit loss, is made on day one. So, and I've been saying this from many years now, that if banks have to move on to ECL, there would be a day one impact. Whether we take it into capital, whether we take it into reserves, or whatever we do, there will be a day one impact. Because as of now, if I have to compare that stage one and stage two, they are still between 0.4 to 1% of provisioning. And maybe when you do a 12-month expected credit loss, certain loans in certain industries or certain types of loans may have more than the range of 0.4 to 1%. And that is where a large amount of difference would be. On stage 3, I generally feel that should not be a difference, because
Your voice is lost. Charanjit ji, your voice is lost.
Sir, I think should I message him?
Yeah, you can message him that his connection is lost probably.
Right, sir. I'll just do that.
You have his number?
No, sir, I'm just messaging. Okay. So can you just share it to me? I'll just call, sir. He has left the meeting, probably has realized it.
वो दोबारा करेंगे तो.
हाँ जी, sir. Correct, sir.
सर आप डिस्कनेक्ट हो गए, दोबारा ज्वाइन कर रहे हैं? हाँ, कर रहे. I don't know what has happened. Your voice was lost, and then you got disconnected also. Okay. He is joining back.
Thank you, sir.
मैं 20 मिनट लगेगा ऊपर पानी भरने में 20 मिनट बैग लगा रखा है
Has he rejoined?
Not yet, sir. Sir, in the meantime, we can request you for some thoughts on ECL so that we keep the.
I think let him come back. Or
Okay.
Vijay is there?
Yes, sir. Vijay sir is there.
Vijay, your thoughts?
Sir, I'm asking him to unmute.
Yeah.
Vijay sir, can we request your thoughts?
See what Charanjit was talking, particularly about the banks, and he said that the moment you give a loan, and that's applicable to any kind of a loan. The moment you give a loan, there is an inherent risk, business risk of it's going bad. And that is one reason why you provide on the standard assets in the case of the banks also. It's not that you only provide in respect of the doubtful debts, you provide even in respect of the standard assets. And that's the reason why you provide for it. And I think something which is going to come to the rescue of the banks ultimately with regard to the regulatory capital requirement would be the standard provision. Because a fair assessment today is that if at all the banks are going to implement ECL model in the near future, probably the requirement of the capital would be in the range of the 4 lakh to 5 lakh crores to the total banking industry. Now, one way of looking at it is that if the Reserve Bank of India can step up this provision in respect of the standard assets for 2 years, and after that you make it mandatory that you have to follow the ECL, probably the capital requirements could be much lesser. The other one, as Charanjit was talking, that in the first year of the implementation of the ECL, you are definitely going to take a big hit. There's no doubt about it, the banking sector. Now, one way that he suggested was that you can debit it to the reserves. No, you can, but whether the Reserve Bank of India will, I think he is joined.
Yes, I'm back. Sorry for this. Sorry for that. I
Yeah,
think
yeah.
some
No,
issue
no
with.
issue. Yeah, please go ahead.
Yes, sir. I'm just sharing the screen.
Yeah.
So, sir, where did I miss out? If somebody can tell me, so I can start from there.
No, you were saying that the banking will take a hit in the first year, and whether they debit it to the reserves or they debit it to the P&L or the regulatory capital requirements are adjusted by the Reserve Bank of India in one way or the other. That's
Yes, sir.
their view, actually.
Yes, sir. So in my view, clearly, sir, the major difference would be in stage 1 and stage 2 rather than stage 3, because that is where the provisioning needs to catch up. In stage 3, primarily why I don't feel there could be a major impact is because these represent the non-performing assets, and banks are carrying a PCR of close to 80% on all of them. So the difference would be only in the balance 20%. So, I don't believe there could be a larger impact. The other impact.
If
Yes,
you
sir.
ask me really, Charanjit, in the third stage, there will be a positive impact in some of the cases.
Yes.
The
Could be.
reason being that we are providing 100% after 5 years, an asset has been doubtful. Whereas in the case of all those loans where there will be security, the value of those securities will be taken care of. The
Yes,
real
sir.
difference will be in the first 2 stages only.
Yes, sir. Perfect, sir. So that is where we believe is where the provisions are going to be. So other impact which most of the banks would have is on the non-fund exposure, sir, which right now nobody is providing. And there again, I believe there needs to be more guidance on that aspect, because as of now, if we use the the credit conversion factors that is used for Basel, there could be very high provisioning on the non-fund exposure, because under Ind AS 109, it is very clear that the provisioning has to be made on the entire exposure and not on only the outstanding exposure. So that is where, and that number of exposure is not now, clearly known. So that itself could be a challenge. And, we would need to, have that impact known. So I believe net there could be an impact once we move on to ECL for the first time on stage 1 and stage 2, and then on the non-fund exposures where I feel there could be a larger impact. If you look at the key areas of judgment here, and that is the critical part that we need to examine, is one on the discounting rate. Now the standard says a rate which
So we are
closely
losing all your voice.
approximates the EIR. Now, if we talk about in the Indian context, we have never been using EIR as a
Charanjit, your this presentation is again,
Easy.
I think, overlapping.
Just a minute, sir. Let me see.
Yeah, this is this was all right.
This is better. So, okay,
Yeah,
I'll share it again.
yeah.
Yes, is it better now?
Right now it is not showing. Now it is all right.
Okay, sir. So, certain key areas of judgments which I thought I should list down. One is on discounting on the EIR part, and I was saying that in the Indian context, computing the EIR is as difficult as computing the ECL because of the data availability. But as of now, wherever I have seen over the period where EIR is computed is primarily based on a straight line amortization, then an effective interest rate amortization. So that something, we'll have to, sort of work around systems and all to get there. Then forecasting, obviously, linkages to, the forecast which have been made internally and all those stuff. So, in some way, at some point in time, if there are large loans, the credit departments within each bank or each institution would have to, develop forecasting models which would test the forecasting of this. Then, definition of lifetime, which again is a key judgment in some cases where there are, loans like in the Indian context, overdrafts, cash credits, and all these things, that the behavioral pattern or behavioral maturity needs to be taken. Definition of default, again, it is different with Basel III norms, and this we are normally following a 90 days default. And obviously the loan commitments. Now, clearly, some of the contracts that we have signed with loan commitments show them they are irrevocable. So the loan contracts will have to be seen whether the loan commitments are really irrevocable or not revocable. If they are irrevocable, then provision needs to be carried on them. So these are the, what I thought I'll put down a list of key areas of judgments which one will have to look at once they're looking at an expected credit loss model. Sorry. Yeah. Now let's, once we have understood, the how the provisioning needs to be done, it's very important to understand what is a 12-month or a lifetime expected credit loss, because this is where the definition or, how do you measure expected credit loss comes into picture. So as I've written on the slide, left lifetime expected credit losses are credit losses that result from all possible default events over the expected life of the financial instrument. So it is not saying when the asset will default once or twice. Even a default in payment of an installment or interest for a 30-day period is considered as a default and the cash flow is adjusted. So one will have to actually look at over the lifetime of a loan. For a term loan, it's very easy to get a lifetime. For other loans, it's a behavioral pattern of you to see when the loan is going to get repaid and when a person or a loan is likely to get default, figure out the default probabilities, work out this cash flow. Now, this is what the standard says. And a 12-month expected credit loss is the part of that credit loss, the portion of the lifetime expected credit loss that results from default events which are possible within the 12 months after the reporting date. So a 12-month expected credit loss will be completely lower and different from a lifetime expected credit loss. So when you're looking at stage one, you are actually providing for a 12-month expected credit loss and not a credit loss over the lifetime. For, again, as I said, the products which I have said like CC and OD, there could be small amount of differences because, generally behaviorally,
And your voice is lost. When he's disconnected,
Yes, sir, he's disconnected. So some internet issue is there.
there's some internet issue.
Vijay sir, can we have your thoughts? We were trying to have your thoughts previously.
Not there. I think Vijay has gone. What I was talking at that particular point of time was that probably in that case, the Reserve Bank of India will be required to say that the regulatory capital requirements can be met over a period of 3 to 5 years. You may keep on disclosing as to what is the shortfall in the capital. Of course, internationally, the position of the banks will be reckoned as weaker. There's no doubt about it, because the government doesn't have the money to actually recapitalize all the banks with that kind of a requirement. There's no way that it can happen. So the only way will be that the Reserve Bank of India, or you can dip into the reserves. But smaller banks may not be able to even dip into the reserves, if you really ask me. So let us see as to what would happen in that particular case. But as Charanjit said, the main challenge will be, I think, yes, joined back.
Yes, sir, he has joined back. I've made him the co-host also.
Okay. Yeah.
My apologies, there's some problem with my internet connection today.
Yeah.
I have to come home and
So, internet problems with Geo, I think it is unheard of.
no, sir, मैं घर पे I was not a
अब
bit.
घर में अच्छा ठीक है,
हाँ,
पर कनेक्शन तो जियो का होगा.
पता नहीं किसका घर check करना पड़ेगा. So no, so just to recap, what I was trying to say, the standard allows you to group various loans in and your financial assets into independent groups to test for impairment and compute the impairment allowance. That group can be basically the key criteria. There is similar risk and categories. Risk and characteristics loans can be grouped into separate groups, and what you apply is a probability of default and a LGD on that. I'll quickly turn to that formula which I have written. So this is the formula which is normally applied, which is for each group, which is each group of loans which is identified. Your ECL is nothing but your exposure of default, which is nothing but your total exposure, which includes outstanding plus sanction limits. PD is the probability of default. Probability of default, as we just discussed, is the probability that a loan will default in its full lifetime, and out of that probability, what is that portion which will of default which will come in the first year. Normally, probability of default is actually determined based on your historical experience. When I mean historical experience, what we do is we take at least 3 to 5 years of data with us, which are in those respective buckets that we have created. We find out, suppose, for example, we had given 100 loans in year one, out of which finally the loans which went into NPA was 5%, and then we look at every year what was the default that the loans had. We take out a weighted average of all those 5 years or 3 years data, whatever data is available, to figure out what could be my average PD, and that PD is used in computing the sort of the provision amount. So that PD goes here, which is the probability of default. Similarly, on the loss given default, is nothing but finally on an asset which got defaulted, what is the amount of loss that you made? Again, from the same data set that you've used, you figure out what is the loss that you may have made, is basically nothing but the outstanding minus the recovery that you have made. So it is 1 minus the recovery rate. So eventually, how you compute provisioning in an ECL is you take the exposure of default, which is your fund base per non-fund basis, multiply it by the probability of default, which means the probability that you have computed based on historical data on how many of the loans default every time in that particular bucket, and you multiply by the loss that you have made on that bucket. Once you get that, then that's what your ECL provision. Now, for the 3 buckets that we spoke about, for every bucket, which is stage 1, stage 2, stage 3, you compute it on this way, because your probability, generally, the only variable which will differ between stage 1, stage 2, stage 3 is your probability of default. The EAD will be your actual EAD, whatever comes from the system in all those buckets. And what will differ clearly is probability of default. Stage 3, the probability of default is assumed to be 100. Stage 1 and stage 2 is what you need to compute from historical data. In fact, the standard gives you 2 adjustments that you can make on this computation. One is a mandatory one, which requires you to factor in any macroeconomic changes. Now, I'll give you a classic example in practical life how it happened. So, in India, if you look at our what has happened, there was a lot of COVID happened, as a classic example where the default ratios could have been different. Then we had the entire thing of where the 500 rupee notes and 100 rupee notes were stopped. There, the experience, was, different. So at that time, when we were computing ECL for, doing the performa reporting to the Reserve Bank of India, clearly the last 5 years data, even if right now, if you want to use 5 years data for provisioning, you'll have the COVID period in between where the data clearly would not be representative or what is going to be going forward. The data would be different. So actually, while making that provision, we actually adjusted for those years of data. We actually replaced those years of data with the last 2 years data, or we just remove those 2 years data while calculating the PDs and the LGD. So, that is something which one will have to do on saying whether the data is really representative of what is going to happen forward. And now the standard says is that you adjust it for also the macroeconomic indicators. Now, what are those macroeconomic indicators? The macroeconomic indicators would be your inflation, would be your GDP, would be your employment ratio or whatever is impacting that entity's performance and that portfolio that you're talking about. Whether this macroeconomic factors are going to remain, or how has the macroeconomic factors affected the provisioning from year to year. Now, there are existing statistical models to do it. I am not one who is very in favor of statistical models if I don't understand them. So simply, it is trying to say, having a logical say, jo hua hai in the past, will it change because of this? It's simple. So one has to have a logical mind to this. The second option, which not an option, but a sort of leeway which the standard gives is voluntary, but which is very onerous, is of the management overlay. If the management feels that, after creating all this, getting historical data, doing macroeconomic factors, if they're not convinced that this number is appropriate, they can increase it by applying a management overlay. I haven't seen a case where the standard is not very clear or not saying whether upwards or downwards. It talks about a management overlay. But the general interpretation is it will be higher than what the numbers are shown and not lower than what your trends are showing. So there is always a management overlay available to the management to apply, but that has its own disclosures and all to make and give the difference between what the numbers, and I believe, though it's not a standard requirement, those should be given if management has used a management overlay. So that's exactly how an ECL is provision. I have actually simplified this to in a particular way, but there are other challenges in this. One of the basic challenges which comes out and which we faced while implementing this was on what happens if there is no data available. If the NBFC or the bank is in the first year of operation, the second year of operation, and the bank doesn't have its own data, or even if data is there, the business model has completely changed so that the old data cannot be used for ECL, and that won't reflect anything. For example, there could be an entity which would be doing, say, project loans all its life, but within the last 2 years, I've shifted the entire project loans to retail loans. So any experience or data on the project loans may not be applicable directly to the retail loan. So what happens in those cases was the challenge we faced. Though again, there are statistical models which people will tell you on all this to apply those statistical models and use the PDs which come out of them. The one solution that we found out is to look at what is the external data available. So for example, for corporate loans, we already have entities like CRISIL and any other credit rating agencies, disclosing PDs of a particular rating asset on a regular basis. So we could use those probability of default of that particular rating assets. Even for a AAA asset, there is a probability of default, maybe very smaller, but CRISIL would give you. So basically, you could use if your entities are rated by an external agency, you can use the probability of default in the similar formula from the rating agencies, any outstanding agencies which are issuing those ratings. The other challenge comes when we were doing this. What if that entity was not rated externally? Then what we thought about to do at that point in time is to rate all our entities on an internal rating based mechanism. Or internally we rated those clients and map our internal ratings to those external ratings which the entity, which the CRISIL or anybody, the rating agencies have done. Once you have mapped that, so your entity according to you already has a rating, and based on that, you can take probability of default. So that was one mechanism which we thought for new loans and new companies we could do it, and sort of get to that number. And we had definitely third party sort of saying in those sort of cases what is the probability of default. Other area was actually came up in consumer loans, which loans where it has been given to individuals. There was no rating, there was no this thing. Incidentally, we spoke to one of the credit bureaus, and we actually got data from the credit bureau. Now they have started publishing it on a regular basis to say if you are in a particular band of score, they give you a credit score, right? A CIBIL will give you a score, whether you are 750, 780. So we used bands of 50 each to say if you're in the band from 650 to 700, what is the probability of these people defaulting? CRISIL has all that data. I mean, not CRISIL. Today, there are many more credit bureaus where you can get this data from who assess individuals. And you can actually get a rating if a person is in a particular rating today, what is his probability of default? And you can actually get that external data and validate with the probability of default that is being used. In fact, in some of the entities, we actually, in our ECL policy, made this as a point that the first level would be internal historical data that we will use. If historical data is not available with us, we will use external data to figure out, what the ECL is. Even if the, ECL is not, data is not available out from there, then only the third part will go on pure management judgment of what could the PD be. Coming to LGD, which is the loss given default here, which means what is the loss that is going to make. Again, same hierarchy. First, historical experience which the company has. If that historical experience cannot be got, or if the historical experience is something which cannot be relied on, we actually, here is where we didn't have much industry data, but we actually picked it up from the RBI Basel norm, because there they've given an LGD of about 70 to 80% depending upon various loans. So you could actually use that till you get internal data. But ultimately, all companies will have to move on to their internal data, because that is what your performance is. And I can sort of tell you, and Chopra ji will agree with me, that even in joint loans, the recovery made by banks or NBFCs are not in the proportion of what their outstanding was. Every bank will recover based on the security it has, and it be based on the recovery process that it follows. So it is very important to go through every bank's internal policies and processes to get it done. But my honest recommendation is before you actually go into a ECL computation, it's very important to, document the ECL policy as a part of this thing, to document how are you going to determine PD, how are you going to determine the LGD. That LGD, this is very, very critical and very, very important to figure out. Other challenges that we faced on, and the industry is facing on basically ECL is the first time transition on how it is going to happen. Even if the regulators give a leeway to adjust it as a part of transition reserve, even now after we have moved on to Ind AS, there would be an impact on capital, and the financial institutions and banks today are really, really, I won't say struggling, but in requirement of capital, seeing the growth in the economy and all those stuff. So it's going to be a challenging. The first movement into ECL is going to be challenging, because I'm sure you would have understood by now that on stage 1 and stage 2 is where, there's going to be a lot of provisioning for particularly larger banks which have larger amount of portfolio standing there. For a bank or an NBFC which is starting, this is not much of a challenge, because you start with that sort of provisioning. In my experience, I'll tell you, on stage 1, generally what I have seen across, globally, banks which have implemented the provisioning or the loss rate is nothing short of 1.5 to 2%. And when we are providing only half of it as of now. So, it could vary for banks. Some banks may have no provision. Some banks may have a lot of provision. You don't know really, where this is going to lead. Just before we get into the Q&A session, and I'm looking forward to it, the loss rate approach, which is clearly approach that is used, the simplified approach that we speak about, is you calculate the loss rate. So when you go into this formula which I've just written, your PD and LGD is combined into given one loss rate, and which again is based on historical data. So where small trade receivables, these receivables, where you don't have a difficulty or will have difficulty in looking at significant increase in credit risk, or hoga nahi, short term hoga, things like which are less than 1 year old, we actually, use this loss rate approach, or what we call it as a assessment on collective basis. Now, I had spoken about where you can actually group loans into based on certain criteria. Now, these are the certain criteria on the basis of which you can group loans, which could be the instrument type, which could be the credit risk ratings, the collateral type, the LTVs, the industry which it can go to, the geographical location, and maybe in some cases, remaining term to maturity. The only challenge is when you start grouping is, the flexibility to change these groupings going forward will be less, because, and I believe there are a lot of auditors on this call as well. For auditors to, accept that every time the grouping is changing may not be a good thing. So once you're trying to group loans into various things, I believe these groupings have to be well thought about. And again, I would again strongly recommend, at the cost of repetition, is have a policy on which how you're going to do ECL. It's not at all difficult. It's not at all looking into this. There'll be many formulas, many statistical models which will be shown to you, to do it. Keep it simple, keep it straight is what my thing is. It's all about, it's not much different from what you have been doing now. It's just that earlier the percentages of provision was given to you by the regulator, uh, and we all didn't know the basis. Now with this standard, it is on the onus of the company, and to an extent, to be certified by the, not certified but reported by the auditors, on whether the provisions that you're making, or the percentages that you're using for provisions is based on your performance, your historical performance, and not on anything which could be termed as arbitrary. So, sir, we can quickly go into the question answer session now, if you're okay, sir. Sir, I can't hear you.
Sir, we are unable to hear you, sir.
मैम सर को आप एक बार अनम्यूट कर हाँ
हाँ जी, right, sir. Thank you, sir.
Who is going to raise the issue? Sunil, Tanuj? No? Charanjit, can you just emphasize on one thing?
Yes, sir.
Because to me, as you said, very rightly said, that so far as the provisioning with regard to term loans is concerned, it's not an issue. The issue will be more of on cash credits and overdrafts. Now, we have in the banking industry a good number of cash credit accounts where throughout the year only 8 entries are passed. Every quarter you have a debit of interest and receipt of interest. Now, how do you look at the risk in these cases? Very frankly, because if you ask me, the risk is great because I see that he's not doing anything. The cash credit was given for the purpose of operation of a particular business. That operation of business is not taking place. How do I really look at that kind of risk? And the other thing is, I think we are all aware as to what is happening in cash credit. If I ever tally the audited balance sheet with the returns that he has submitted, what happens is that in the balance sheet, the audited balance sheet, the debtors figure, the stock figures are always lower compared to what he has submitted in the stock statement based upon the DP has been given. He has been operating the account. And the creditors figure may be 3 times of what he has submitted in the returns for that matter. Now, this behavioral pattern actually creates doubt. And probably the probability of default in these cases is much larger than what is actually being represented in the data, because these accounts have not been classified as the bad debts. Similarly, in the agricultural loans, if you ask me, which constitutes today about 15 lakh crore worth of loans in the banking sector, there are, number one, either there is no classification for even beyond 3 years in some of the cases. And in Kisan credit cards, you get only 2 entries at the end of the year, the cash received and cash paid for that matter. And if you really look at some of the cash flow registers, you don't get even the entries, or you get the entries where there is no denomination is there. It is nothing but evergreening of the loans. But if I go by the historical data will say that these loans have not turned NPS, basically. How do I look at those situations?
So I'll just break this question into two parts. On the first part on cash credits and overdrafts, I think there what realistically needs to be looked at, if we had given him a working capital loan at the beginning, what was expected out of that working capital loan, and how has the company fared over a period? And if the company is not fared, you could clearly, actually what we determine when you move from stage 1 to stage 2 is whether actually the credit risk has increased significantly and whether the probability of default has increased. So once you see the financial numbers, and that will be the audited numbers at the year end or whenever you get it, you'll actually figure out that, whether if the credit risk has significantly increased, then this will automatically move into stage 2 and one will get the probability of default there. And the only challenge there, and you're right in saying that, is you'll never see a default in that account, actual default, because it will be some credit entries would come at the time of, and basically installment and interest would be received. So that is where I said, if you remove that criteria of whether there's been a default or not default and look at the company's performance and the company's ability to pay, that is where you'll make a judgment there to say whether we need to actually make a provision or not a provision. And if there is significant credit deterioration, you'll have to make a provision that there is no running out of that. So you won't actually look at what's happening in the account. You'll actually look at what is happening in the signed audit balance sheet. And the other requirement of the standard says that you're not looking at one facility alone of the borrower. You look at all the facilities of the borrower taken together. So you look at one company as a whole, taken all facilities, and then assess whether that company ka risk has increased or not from the time you sanction the loan. And if the things like turnover, the other ratios are not increasing, and there has been an increase in credit risk, the provisions will increase automatically once you put it into stage 2. So the classification between stage 1, stage 2 will be very critical. And then again, as I said, nothing stops you from taking a loan from stage 2 to stage 3 itself, even if it is not a default. It is at close to default. One can easily make out from the financials and the repayments that are happening in the account to say that these account, though it is not defaulting, but it is supposed to default because it never paid, there are no operations, and all those criteria. One has to, so that is why the ECL policy is so critical for cash credit accounts. That needs to be first, discussed and decided on what is the basis on which you're going to provide. So this basis should be documented there. Just seeing the credit repayment in the account will not be sufficient. It has to, the company has to be seen in total, whether my money is secured, whether I'm going to recover the amount in the due time. What is the time when I'm going to close this facility? If the person is not using it, the money should be taken back and there should be a time limit place. So that companies will be forced to do that. So I believe clearly in those cases will get covered when we start looking into in depth on what is happening on a company-wise portfolio. On agriculture loans, though I believe we did that in the past, we did some banks where we were making provision on agricultural loans. The question there, sir, more that challenge we faced was not on the history, because in the history we get defaults for sure. Some defaults are waived, you get a government waiver and all those stuff. But the real challenge there we faced was exactly what you said, the two harvest seasons or the two seasons where it comes, and how that needs to factor in when you're calculating your probability of default, even on historical data. In some of the cases, sir, we didn't go into PD, into LGD. We started using loss rates as such. So if in a particular season, if I have given 100 crores, and we didn't look at the number of loans. We said if we had given 100 crore of loans, finally at the end of that period, I recovered only say 98 or 99 or maybe 90. So the 10 crore provision is 10% provision, and we created provision of 10% on that. So one will have to look at a very, very pragmatic way of looking at cases. What has been the loss and what is the expected loss into my portfolio. Yes, agriculture loans will be a challenge till the time we don't have the data. I think today in the banking system as a whole, except for a few banks which I can count on fingertips, the data is not available in that detail, because banks have moved, systems, moved in technologies. Some data has been lost in that movement. You can't get that data, particularly relating to EIR and ECL, where the data is clearly not available with the companies. Once the data is available, then it becomes a little bit easier to figure out what has been the loss. So ultimately, what we are arriving through PD and LGD is the loss rate that we have actually suffered in that. We may use a discounted value based on the term of the loan, but the loss rate can be definitely worked out, sir, in those cases.
Before I hand it over to Kriti for her question, I have another question. You see, number one, you talked of dipping into the reserves in the first year, or the alternate solution was that probably the regulatory capital requirements can be deferred for a period of, or can be spread out. This regulatory capital requirement can be spread over a period of 3 to 5 years, as we did in the case of the employee benefits earlier. So, even if we do that, very frankly, for a period of 3 or years or 5 years, we'll have to make a disclosure. And if we make a disclosure, the analysts abroad or internationally are able to read what is the strength of a particular bank.
Yes, sir.
So that's, to me, that is the major challenge, basically, if you ask me.
So there, obviously, disclosures will have to be made and the numbers will have to be stated. But I think, sir, analyst, my own view, again, I can be wrong, but I think the analyst will understand this, because everybody understands that ye first year to loss hoga. First year ka impact aayega, because we are moving to a more, what I would say, upfront provisioning rather than provisioning after getting into a default. So that sort of, what I call it as accelerated provisioning is there. So that impact will be there, and analysts will have to take it. It's a one-time knock which everybody will have to take. And I think what analysts will look at is more of the future than what has happened in the past. Because whatever we are going to provide is the loss which has already been made. I mean, we are not providing for something which is there, and maybe some part of it will happen in the future, which we are providing it today. So I think the analysts should look at it in a more positive way.
And what do you think that if we do it after 2 years now, ECL, probably the last 5 years data will be very good because you have already written off most of the NPS.
Yeah.
All IBC losses, major losses have been booked already, barring few which will come in the times to come. So probably at that time, the regulatory capital requirement may not be as high as we expect it to be today. That's my way of looking at it. If we can defer it by another 2 years, probably the 5 years data that we will be looking for, I think this will be much healthier than what it would have been otherwise.
Yes, sir. I agree with you with the sort of performance that we are seeing in the last 3-4 years. It's been phenomenal. And even now, as we talk about, there are quite newspaper articles which are saying that the credit cost will come down. So you're right, but sir, look at it this way: your absolute standard asset portfolio will go up. So their incremental provisioning will be there in spite of your past performance. So if you're talking about a good economy, number to badenge, provision to aayega. So, from that perspective, it's until and unless banks, and I've seen certain private sector banks, they have started making provision on standard assets more than what is required. Primarily taking into consideration that someday Ind AS would come, and this provision will be required. So maybe if banks are prudent enough to start making that for RBI, no, I totally agree with you that it has to be ECL. If it has to be brought today to the banks in India, has to be in a very, very phased manner and not all at once. So maybe RBI can start with the phase 1, phase 2, stage 1, stage 2, stage 3, and still give percentages for the banks to try it down. And then over a period, increase those levels and then leave it to the banks to compute on their own. So maybe that could be a trajectory on which ECL can be implemented if RBI is keen on implementing ECL in the banks. And that is what the entire world is doing.
Yes, Kriti.
Yeah, good evening, sir. Sir,
Good.
I had two questions basically. Since, as an external auditor, this kind of concerns us. So, sir, first, when we talk about, like you mentioned in the presentation which you were giving us, that the internal policy of the bank is very important. So, sir, but there are certain things which are mandatory from the RBI's perspective. So, sir, how do we kind of bridge that gap, that what a policy a bank may be having a risk-taking capacity as per their own policies? But as per RBI, there are certain things which need to be capped on or need to be tapped on, sir.
So, see, a regulator will always have its own controlling measures. No policy can go beyond those regulatory measures. So, for example, what I spoke about is having an ECL policy on how you would compute provisions. It's more akin to like an accounting policy, where you show how will you go and determine your ECL, how you're going to determine your probability of default and so forth and so on. And if there are regulatory restrictions, it has to take into consideration those regulatory restrictions, if there are any. As of now, I don't think of any regulatory restrictions, because once ECL, like if you see what RBI has done for NBFCs, though it has kept a floor of provisioning as per IRAC norms or standard assets, but it is clearly said that if you're following ECL, follow ECL. Only if the total provisions is less than what is minimum required, you transfer to a reserve or anything. So I think when RBI implements ECL, if there is anything conflicted, that will get changed for sure.
So just taking ahead only on this thing, like we have RERA, that's a regulatory authority, sir. And we have certain restrictions out there that, the QPR, HPR has to be submitted timely. But, when we see from the bank's perspective, as an external auditor, we look into those things. But for bank, they are not monitoring those things because there is an SCOD date, there is an extension. I agree there has been COVID, which has just surpassed us, and we have got out of it. But all these factors also, should that be a part? Or like, I just wanted to understand that part, sir.
So again, the clearly thing is, how does the bank assess its credit risk? Now, if these factors are important for assessing credit risk, it will get factored at the time of assessment of credit risk as well, and at the time of assessment of ECL as well. But if these factors, what you're talking about, though I'm not a this thing expert on RERA, but the question clearly is, if those are important milestones to be achieved and which affect your repayment schedule, that needs to get factored in your ECL when you're actually looking at whether the credit risk has significantly increased or not. So even if the bank is not monitoring, the data has to be with them, how they're monitoring. In fact, I have seen that in practicality, that in various committees, boards have started discussing when they're sanctioning the credit committees on what is going to be the ECL provision on day one for this loan that we are doing. So that sort of reckoning comes into at the time of lending. See, today, at the time of lending, everything is allowed. Nobody questions anybody. The risk department says, "Ye rating hai, go ahead, disburse." Why question it at the provisioning? At the time of provisioning, क्यों information नहीं आती? I always kept on telling the banks who told me कि information नहीं है, ये नहीं करते हम. तो आपने disburse कैसे किया? You're giving loan to somebody. How can you not understand a party before giving a loan? So what you're doing at the time of giving a loan, you tell me now what is the position. The same standards. And I'll see whether there is a deterioration or not. If there's a deterioration, you have to make a provision for it, because what you assessed at that time and you thought was valid and you granted it on today, that may not be the situation.
Yes, Tanuj, last question.
Thank you, sir.
Hi, sir. So
Hi.
actually, our questions are actually two. Number one is related to NBFCs. So under NBFC, like almost all the NBFCs are as of now having two categories of NPA. Number one, which have actually breached that threshold of 90 days and are appearing under stage 3 of the ECL policy or the ECL model. Other ones are the assumed NPAs, which has been classified as NPA because of RBI's November 21 circular, but are actually sitting under either stage 1 or stage 2 of the ECL model. So when we are computing probability of default, are we required to take into consideration both of these categories, or only the ones which are actually classified under stage 3?
So let me answer that question in a different way. Probability of default is to be calculated on all stages. It has nothing to do with stage 1, stage 2, stage 3. Now, coming to this specific type of loans, it depends upon where you group them. And I would generally feel all these types of loans will be grouped under one category, and where the PDs for these type of loans would be different, because these cannot be clubbed with any other category which you have until and unless you believe that they carry the same risk characteristics which other loans carry and you can merge it with them. So technically, from a clear Ind AS 109 perspective, this would form a separate group and you'll have a different probability of default for this, maybe a little bit higher than what you're using it for other groups in the same stage, in stage 2 itself. But in my first question is, RBI has made some deemed NPAs as per its circular, right?
Right, sir.
Try to again put RBI and ECL as a comparative provision. Independently, if you're doing ECL, where would you put them? Would you put them in stage 2 or stage 3?
Independently,
the
they will
decision
fall
which
under
you
stage
take.
2. For an example.
So, for example, I'll clearly tell you, there was a draft guideline by Reserve Bank of India which said all restructured assets will have to be classified as stage 3.
Right.
Whereas IFRS 9 always spoke about that you book the loss on restructuring what has happened on a present value basis. And based on the new restructured terms, you decide whether it's in stage 2, stage 1, or stage 3. Because that, from a classification perspective, becomes a new loan after you have restructured it, which would mean that the credit risk is improved. Otherwise, you won't restructure a loan if its credit risk has not improved. So basically, whenever you're deciding for the classification, it has to be independent of any other thing. You have your ECL policy, you have a basis of classification. Please go ahead and classify first on that. and then try to move and calculate probability of default. Otherwise, you'll always get jumbled up between what is regulatory required and what is required from an ECL perspective. ECL is an accounting standard prerogative. Use it independently, then look at regulations and see how do you comply with the regulation. You'll get answers to everything.
Understood. So then question number 2, only 1 minute. In case of a manufacturing entity, like there is a manufacturing entity which is also having some pool of loans given to its group companies as well as to third parties as well. Now, none of the entity has its credit rating. Only the company which is giving the loan has its credit rating, being a big entity. Can we draw a model in this way that based on this entity who is giving the loan and whose credit rating is available, we can work out the based on some of the ratios and all, we can work out the credit rating of those entities to whom the loans are given, and a probability of default can be assigned to them based on that. Can this statistical model also be worked out and can be treated as an eligible model under ECL?
No, I didn't get. You're trying to say that you have given a loan to a company who in turn is giving loans, right?
No, sir. Our company is like this entity X is giving loan to entity Y.
Correct.
Now, this is a financial asset on which ECL computation has to be ascertained. So for that purpose, there is no because that entity is a manufacturing company, so there is no much of the historical information available for the defaults in the past. Then there is no credit rating also available for the entity to whom the loan is given. But credit rating is available for the entity who is giving the loan.
Go ahead.
So in this case, based on the credit rating of the lender entity, can we work out based on different ratios and all? Can we work out that if based on many of the ratios, can we work out the credit rating of that entity who has actually received the loan, so that that PD, which has been assigned by the rating agencies against that rating criteria, can be allocated to that loan?
See, I mean, this is making things a little bit more complicated. It's like if the manufacturing entity is rated. So I believe the rating agency has done its own job in looking at the ratings of the underlying assets it has and all those stuff. So in a way, we can rely on that rating. But if you really feel that the rating agency is not a reputed rating agency or something which you can't rely on, then obviously you will have to do an internal rating of that manufacturing entity. And when you do retain the rating of that entity, you'll obviously look into the loans, the unsecured loans, and all that has given, and what you said will get worked backwards. So that is completely acceptable.
No, but there can be a case, Chiranjit, where when manufacturing company was rated, at that time there were no financial assets, and the financial assets have been given later. At that, because those financial assets would not have been rated, to which subsidiaries you had given the loans, very frankly, or to whichever entities you have given the loans, these are unrated. And when you rated the manufacturing company, at that time these loans had not been given. So accordingly, whatever weightage could have been given to those loans, or probably certain adverse features which could have been attached to these loans,
will get attached to
into the credit rating of the manufacturing company.
Yes, so the company will have to get re-rated.
Yeah, that is the point I'm trying to raise.
Yeah, the company will have to be re-rated if there are major transactions happening after the discovery. And anyway, once in a year, the good practice that is followed, at least once in a year, the company should be re-rated, if not more frequently.
So, to my mind, now there are no more questions.
Mr. Ranjan has a question. Mr. Ranjan has a question.
Mr.
Ranjan.
So may I ask, am I audible?
Yeah, you're audible.
Yeah, good evening, sirs. So my question is on ECL formula. Like, if future cash flow is a pivotal role for this. I mean, I just wanted to know where future cash flow forms part of this formula. Second is for loss given default, how do we derive it? Or similar benchmark is available, like we have external agencies for probability of default? Yeah, that's it.
Yeah. So I'll answer this question in two parts. One is your cash flows are involved in calculating your probability of default as well as loss given default. So either you take up, see, for assume a company which you're, sort of, or a group that you're assessing, which has, is a large group, large exposure, and which has businesses in various industries. You may not be able to put that group in any of the one criteria with similar list. So you want to sort of assess that group separately. You may want to look at their cash flows independently instead of clubbing. There you'll actually look at what is the probability of default in their cash flows and make scenarios and assess and assign probabilities and derive the probability of default. That is one way of deriving the probability of default. And in many cases, particularly in the banks, we have, when I have insisted that, at least for the top 10 or top 20 accounts, you do individual assessments rather than doing group assessments. So that is where cash flow comes in. Again, when the formula which I'm saying, for calculating probability of default or the loss given default is your cash flows itself. When I mean by probability of given default, you're actually going to look at the cash flows and see when the person defaulted and for what time, and then calculate the probability for every loan. So when you do it in a group of loans, you see the combined cash flows of the group watches happen because of the enormity of the task and the enormity of the loans. You can't do it loan by loan basis, and it really doesn't make sense to look at it loan by loan basis. So that is how cash flows get factored in. On the other question, are there any agencies for loss given default? As I said earlier, also there are no agencies. There is a Basel, number the RBI gives for loss given default, and there cannot be an industry guide per se because every bank, every institution will have its own recovery methods and own recovery policies, and even in joint loans or in various loans where the bankers, multiple bank arrangements where loans have been given, I have practically seen that the recoveries have not been in the proportion of the loan outstanding. It all depends on individual banks. So all banks will have different exposure, different recovery cycles. So I'm not sure whether having an industry benchmark there would help. But I have also said that, if we want to implement ECL in a graded manner, we'll have to start with benchmarks and then leave it to the banks to do things on its own.
Okay, thank you. I mean, just wanted that clarification on whether probability of default only depends on the historical experience or it also depends on the future cash flow. So as you said, it depends on the both. They factor the both, right?
Yes, yes, yes. So as I said, earlier also, you first look at historical data. Once the historical data comes, the management has two things to do. One is mandatory, where you have to factor in impact of macroeconomic indicators, which essentially means how it's going to flare out in the future. And then obviously there is management overlay where you feel, this is not appropriate, you need to increase it. You can have a management overlay and increase the probability of default.
So thank you very much, Charanjit.
Thank
We
you,
had
sir.
factored in, we had actually invited you for 45 minutes. We have taken an hour and a half of yours, which is
Sir,
absolutely the double the time. I must say it has been pretty taxing for you, but but it has been very, very much beneficial to each one of us who
I
are
hope.
there. There are certain people on the YouTube also.
Mhm.
So it's a very complicated topic. We all know it. There's no doubt about it. And after implementation, only you learn the lessons, and this also gets stabilized only after some period of time in any organization for that matter. But Charanjit, thank you very much for acceding to our request at a very, very short notice, if you ask me, and giving a wonderful presentation and very, very beneficial. I must say that one goes from here absolutely enriched in the knowledge, and whatever questions have been asked, each of the questions has been answered, responded to very, very to the satisfaction of each one of us. Thank you very much, Charanjit.
Thank you so much, sir, and sorry for the internet
No, not the least, not the least.
Yeah.
So, thank you.
Thank you,
So,
sir.
thanks to everyone for the participation, raising the issues, and I must thank Vijay in absentia also for a wonderful presentation. I think today has been one of the best days so far as pillars and GSA together are concerned. We had wonderful discussion on both the topics for that matter. So thank you very much to all the participants also, and thank you very much to Vijay and Charanjit. Thank you.
Thank you.